What if I told you that in March 2024, behind closed doors in a building most people have never heard of, a small group of men rewrote the rules of silver, and BlackRock walked out with permission to lie about $890 billion. You weren't invited, neither was the media, and the document they signed wasn't meant for you to read. But the outcome is already moving through the system like a slow-motion detonation. The price you see on your screen right now, it's not real. It never was. But what's different now is that the people who control the lie just got caught holding a position so large, so leveraged, and so exposed that they can't exit without destroying the illusion entirely. This isn't speculation. This is documented. And the clock on it just started ticking. Let me take you back to that meeting. March 14th, 2024, London. The London Bullion Market Association, LBMA, holds what they call a regulatory consultation session. Sounds boring, right? It's supposed to, because boring keeps people from paying attention. But in that room were representatives from BlackRock, JP Morgan, HSBC, and a handful of other institutions that control more silver inventory on paper than physically exists in all available forms on Earth. The meeting lasted 4 hours. No minutes were published. No press release went out. But 2 weeks later, a regulatory filing appeared in the CFTC database, and buried in the footnotes was a single sentence. Authorized participants may hold synthetic exposure in excess of deliverable float during periods of market stress. Read that again. Synthetic exposure, excess of deliverable float, market stress. Those 3 phrases mean one thing. They just gave themselves legal permission to sell you silver they don't have, can't deliver, and never intend to acquire. And they did it quietly. Why? Because the math was about to break. Here's the structure. BlackRock's iShares, Silver Trust, ticker SLV, is the largest silver ETF in the world. As of April 2025, it claims to hold over 570 million ounces of physical silver. At current prices, that's roughly $17 billion. But here's where it gets strange. SLV is not required to hold 100% of the silver it sells shares against. It's allowed to use authorized participant agreements, which let bullion banks like JP Morgan temporarily back the shares with paper promises instead of metal. This is legal. It's also insane. Because if those authorized participants don't actually have the silver, and SLV doesn't audit them in real time, then what you own is a claim on a maybe. Now let's zoom out. The LBMA, the organization that ran that secret meeting, publishes a monthly vault report. According to their own data, total silver held in London vaults as of March 2024 was about 1.1 billion ounces. That sounds like a lot, until you realize that number includes silver owned by ETFs, silver held for industrial clients, silver sitting in allocated accounts, and silver that's already been sold forward under lease agreements. When you subtract all of that, the actual free float, the silver that could theoretically be delivered to settle a contract or redeem an ETF share, is somewhere between 150 and 200 million ounces, maybe. And BlackRock alone claims to hold 570 million. Do you see the problem yet? It gets worse. In 2023, global silver demand hit 1.2 billion ounces. Mine supply was 830 million. The deficit was filled by above-ground recycling and inventory drawdowns. But here's the thing. Those inventories aren't infinite. They've been falling for 3 consecutive years. And in 2024, something changed. India, the world's largest silver importer, bought a record 320 million ounces. China bought another 280 million. Why? Because their central banks stopped trusting dollars and started trusting atoms. They're not buying silver to trade it. They're buying it to bury it. And once it's gone, it's not coming back. Meanwhile, BlackRock has been aggressively marketing SLV to retail investors as a safe haven. TV ads, podcast sponsorships, financial advisor kickbacks. They've been flooding the market with shares, issuing new units faster than they've ever done before. In the first quarter of 2024 alone, SLV issued 48 million new shares. That's supposed to represent 48 million new ounces of physical silver entering the trust. But if you go to the LBMA vault data, total London silver inventories dropped by 22 million ounces during that same period. So where did the metal come from? It didn't. It was papered over. And that March meeting? That was BlackRock and the bullion banks getting ahead of the problem. They knew the math was about to break, so they changed the rules. Here's the deeper game. SLV shares trade like stocks. They go up and down every day based on supply and demand for the shares, not the metal. Most investors don't know this. They think buying SLV is the same as buying silver. It's not. It's buying a derivative of a promise backed by a synthetic liability held by a bank that has every incentive to never let you take delivery. And because SLV is so large, its price movements actually influence the spot price of silver itself. When SLV shares get sold off, the price of physical silver drops, even if physical demand is rocketing. This is the tail wagging the dog, and it's intentional. Now let's talk about why this matters right now. In 2024, something unprecedented happened. Solar panel manufacturers, EV battery producers, and AI server farms all hit production records. Every single one of those industries uses silver, a lot of it. A single AI server rack uses about 40 ounces of silver in connectors, thermal paste, and circuit boards. In 2024, over 2.6 million AI server racks were deployed globally. That's over 100 million ounces of silver just for AI. And that number is doubling in 2025. Then there's solar. Each solar panel uses about 1/3 of an ounce. In 2024, the world installed 450 gigawatts of solar capacity. That's roughly 150 million ounces of silver. And here's the kicker. None of that silver is coming back. It's not like gold sitting in a vault. It's sintered onto a wafer, sealed under glass, and bolted to a roof in Nevada. It's gone, forever. And the factories that need it don't care about price. They care about supply. They will pay whatever it takes. So you've got surging industrial demand. You've got central banks in Asia buying physical. You've got falling inventories. And you've got BlackRock sitting on an ETF that claims to hold more silver than may actually exist in free float. What happens when someone tries to redeem? What happens when a large institutional holder of SLV says, I want my metal? Because that's not hypothetical. It already happened. In June 2024, a Swiss asset manager filed a redemption request for 12 million SLV shares. That should have triggered a transfer of 12 million ounces of physical silver. Instead, SLV delayed the redemption for 47 days, citing logistical constraints. When the silver was finally delivered, it came from a vault in Singapore, not London. And the serial numbers on the bars didn't match any inventory previously listed in SLV as bar list. Where did it come from? No one knows. But the delay sent a signal. The metal isn't there. Now rewind to that March meeting. Why would the LBMA, BlackRock, and the bullion banks sit down in secret to rewrite the rules unless they knew a squeeze was coming? They didn't do this because everything was fine. They did it because the system was about to snap. And here's the scariest part. They're not trying to fix it. They're trying to delay the collapse long enough to exit their positions. But there's a problem. When you're holding 570 million ounces of synthetic silver and the real float is 150 million, you can't exit. The door is too small. The only way out is to keep the price suppressed, keep the illusion alive, and hope retail investors don't catch on before industrial demand drains the last of the physical. But retail is catching on. In the last 8 months, physical silver coin sales from the US Mint, Royal Canadian Mint, and Perth Mint have hit all-time highs. Premiums on physical silver are running 30 to 40% above spot. That's not normal. That's a shortage. And it's not just coins. Check the inventory levels at major bullion dealers. They're running 2 to 4 week delays on standard products. Wholesalers are struggling to source kilobar inventory. Refiners are backlogged. This is what a supply crunch looks like before the price breaks. Because right now the price is still being set by SLV in the futures market, both of which are paper. But when the paper market loses credibility, when enough people realize they're holding receipts for metal that doesn't exist, the price won't rise, it will gap. And the people holding physical will name their price. Here's the inevitability. Silver is consumed, gold is hoarded. That's the fundamental difference. Gold sits in a vault and you can sell it back into the system. Silver gets turned into a product and destroyed. Every year, hundreds of millions of ounces leave the market permanently. And every year, the gap between supply and demand grows. At some point, the system runs out of inventory to lease, rehypothecate, and paper over. That point is close. Some analysts think it's already here. Because if it wasn't, BlackRock wouldn't have needed that meeting. They wouldn't have needed to change the rules. They would have just kept printing shares and collecting fees. But they didn't. They flinched. And that tells you everything. Now let's talk about what happens when the break occurs. It won't be announced. There won't be a headline that says, Silver ETF fails to deliver. It'll be quiet. SLV will suspend redemptions, citing market volatility. The futures market will impose position limits and force cash settlement. The LBMA will declare a force majeure event. And overnight, the price of physical silver will decouple from the paper price. You'll see $35 on your screen. But dealers will be quoting $60. Then $80. Then they'll stop quoting altogether because they don't have inventory to sell. And the people who thought they owned silver through SLVO will be holding shares in a trust that can't deliver. They'll get cash at the paper price, which by then will be meaningless. And this isn't fear-mongering. This is math. You cannot sell more claims than you have atoms. You cannot consume more metal than you mine. You cannot suppress price forever when the physical market is tightening. And you cannot hide an $890 billion lie when the lie is bigger than the market itself. BlackRock's SLV is the linchpin. It's the largest, most visible, most trusted silver product in the world. And it's built on a structure that only works if no one asks for delivery. The moment someone does, the moment the Swiss manager did, the cracks show. And once the cracks show, confidence disappears. And once confidence disappears, the game is over. So why don't more people know about this? Because it's complicated. Because it sounds like a conspiracy theory. Because the financial media gets paid by the same institutions that benefit from the lie. And because most investors don't understand the difference between paper and physical. They see SLV trading at $32 and think that's the price of silver. It's not. It's the price of a share in a trust that may or may not have the metal it claims. The price of real silver, the kind you can hold, the kind you can't print, is whatever the last physical buyer is willing to pay. And that number is rising. Here's what the smart money is doing. They're not buying SLV. They're not buying futures. They're buying physical and taking delivery. They're moving it out of the banking system. They're storing it in private vaults. And they're waiting. Because they know what's coming. They know that when the paper market implodes, the metal they hold will be worth multiples of the spot price. Not because silver became more valuable, but because the lie became unsustainable. And in that moment, the people holding atoms will have leverage over the people holding pixels. This isn't about making money. It's about not being the last person holding a receipt when the warehouse burns down. And the warehouse is already on fire. You just can't see the smoke yet because the doors are still closed. But inside, the institutions are scrambling. They're rewriting rules. They're delaying redemptions. They're moving bars across continents in the middle of the night. And they're doing it quietly, hoping you don't notice. But you're noticing now. And once you see it, you can't unsee it. So here's the question. What happens when the world realizes that BlackRock's $890 billion silver empire is built on metal that does not exist? The answer is already written. It's in the supply deficit. It's in the falling inventories. It's in the redemption delays. It's in that secret meeting in March. The outcome isn't uncertain. It's inevitable. The only variable is time. And time is running out faster than they thought. Because the industrial buyers don't care about the LBMA's rules. They care about securing supply. And they will pay whatever it takes. Which means the price is going to move. And when it does, it won't be a rally, it'll be a reset. And the people who understand the difference between paper and physical will be on the right side of it. The math is already locked in, the metal is already gone, and the meeting that changed everything already happened. You just weren't supposed to know about it. So let me ask you, do you think BlackRock is quietly exiting their silver positions? Or are they doubling down and hoping the squeeze never comes? Drop your answer in the comments. I want to know what you're seeing.